The Polish Central Bank expects the country's commercial banks to tighten lending conditions further for consumers and businesses in the fourth quarter because of a deterioration in both of the economic outlook and their portfolios. The Wall Street Journal Emerging Europe blog reported. Poland's conservatively managed banks with negligible exposure to toxic assets and a low bad debt ratio have proven resilient to the economic crisis that has roiled the Eurozone. The average debt of consumers in Poland is lower than in more affluent countries in Europe, reflecting prudent lending policies of the past, relatively high interest rates, and Poland's status as one of the least developed members of the European Union. But tighter lending may exert more pressure on Poland's economy, already growing much slower than the past few years, as the government tries to limit the growth of spending to meet deficit targets. Second quarter growth fell to 2.3% annually from 3.6% in the first quarter as the European debt crisis as cooling domestic demand also take their toll. As the economy has slowed, the country's lenders have felt the pinch with provisions for non-performing loans rising rapidly and demanding for credits dropping. The expectation for tighter lending conditions in line with banks' current policies, which have seen a gradual increase in margins, higher guarantees and lower credit limits in the third quarter, the central bank said in a credit market report. Demand for corporate credit is expected to fall in the case for long-term loans, while increase in demand for short-term loans is expected, mainly from large companies. For housing loans, banking also expects to tighten the criteria after some easing in quarter one, while demand is expected to rise after some growth was recorded in the first 4 months of the 2023. The survey was conducted in early April among 23 banks, whose aggregate share in enterprises and houses liabilities constitutes some 89% of the banking sector portfolio. The questions were addressed directly at the heads of the bank's loan committees.